Hello and welcome to Vanguard's latest economic and market outlook update. My name is Jan-Karl Plagge, Head of the Investment Strategy Group APAC and Global Head of Indexing, Active and ESG Research. I'm joined today by my colleague Grant Feng, who is a Senior Economist here at Vanguard APAC. Now in this update, we'll share our perspectives on recent economic and market developments, provide context around what's driving current conditions, and outline our latest outlook for both equity and fixed income markets. And we'll try and disentangle what all of this may mean for investors in the month ahead. Let's begin with the key drivers shaping global markets and economies today. Our key conclusions can be summarized in 3 points. First, risks have shifted towards the tensions in the Middle East. The tension-induced renewed energy supply shock has lifted inflation and is weighing on growth. That said, we expect the impact on markets to be fairly limited absent any further escalation. Second, we believe that AI will remain to be the most influential driver for the economy in 2026. So here, nothing has really changed relative to our assessment from earlier in the year. In fact, AI investment is even tracking somewhat above our expectations, supporting growth, but also, to be honest, there are some risks arising. And third, our investment outlook largely remains unchanged. We continue to favor high-quality fixed income, US value stocks and developed markets, ex-US equities. With that, let's start by talking about the implications of the steep rise in energy prices that is on top of many people's minds these days. Grant, you put together an assessment that allows us to understand the implications for economies around the world and Australia in particular. Can you walk us through your thoughts and the model?
Yeah, thank you, Jan, of course. So what's important to point out now is that the impact of the energy shock actually varies depending on each country's energy matrix and economic structure. So on the left, you can see the energy matrix by source. And we do see some large economies like China and India actually rely less on oil and gas than the world average, and much less than Europe and the US. For example, China still has coal as a large share of the energy consumption, and also have a very strong advantage in green transition. However, for most of the Asian countries, energy crisis is a notable headwind. So the next question is, how much the region really rely on the imported energy? And on the right is the second part of the story, which is import dependence. And we can see the standouts are Japan and South Korea, where net energy imports are actually very high as a share of energy use. But Australia, on the other hand, is an outlier, because as a large net energy exporter, higher commodity prices would improve the terms of trade and provide a buffer to growth headwinds. And actually, Australia is the only country in this region whose currency appreciated in March. So the punchline for market is very simple. Energy shocks can create uneven impact across the whole region.
Yeah, thanks, Grant. Really interesting to see this more nuanced view here. Now, before we move on, I think it makes sense to address one concern that many investors have whenever geopolitical crises happen. Many ask themselves whether they should either stay invested or de-risk or maybe leave the market altogether. Now, in order to give investors some guidance, we have assessed the equity market's reaction to 7 historical episodes, all of which were connected to geopolitical shocks. And what we can conclude from this assessment is that equity market drawdowns tended to be relatively short-lived. What's more, we find that markets recovered relatively quickly. That's what we see on this slide here. On average, global equities delivered around 8% in total returns just 6 months after the initial geopolitical shock, and were up as much as 15% 1 year later. The key message here is not that geopolitics doesn't matter. It clearly does. Rather, it's that markets tend to absorb these shocks faster than investors may expect, especially when the underlying drivers of market fundamentals remain intact. For long-term investors, short-term volatility should therefore be viewed through the lens of long-term macro forces such as technology adoption, globalization, demographics, and debt dynamics, which are all far more influential of long-term performance than short-term events and market volatility. And now with that little excursus into global capital markets, let's move back to home, closer to home, and to the economic side of our discussion today. In Australia, we find that the renewed energy shock occurs at a time when inflation is already quite high. Grant, what do you think this means for the policy path down the road here in Australia?
Yeah, thank you, Yang. It's a very timely question. Well, the oil shock, combined with the high inflation, have already triggered 3 consecutive rate hikes so far this year. And as a result, we think the RBA has very little room to relax the policy in the near term. And this slide explains why. Let's start from the left. We can see both headline and trade mean inflation actually remains well above the RBA's 2 to 3% target band. And importantly, the RBA has already missed the midpoint of the target for roughly 5 years. So even after the pandemic, we can see the underlying inflation is still very sticky, sitting well above the target. So for the RBA, that's a credibility problem. And what makes this even harder is what we show on the right. We can see consumer confidence has fallen back to levels last seen during the COVID outbreak. And we can see the households are clearly under great pressure from higher interest rate and the cost of living, even while the labor market here still remains very tight. So the economy is caught between 2 forces. On one hand, the sticky inflation means that the RBA cannot declare victory yet. And on the other hand, the weak confidence means economic growth is still very fragile. This combination actually leaves very little margin for any policy error, because easing too early would risk re-accelerated inflation. But holding the policy too tight for too long will raise the risk of an unnecessary economic slowdown. So our base case is that this pushes Australia into a higher for longer interest rate environment, with any rate cuts would come later and more cautiously than market might hope.
Okay, thanks, Grant. Now, we talked a lot about AI in our outlook back in January, February, and since then, a lot has changed. Have the recent geopolitical events that we just talked about impacted our view on AI at all, or does AI stand somewhat separate from it all?
Yeah, very good question. And as you just mentioned earlier, while geopolitical events usually result in near-term market turbulence, but they rarely change the long-term economic and market fundamentals. Now, the energy headwinds actually sits alongside a very different driving force, what we call AI tailwinds. And this slide provides hard evidence that the AI upswing cycle is actually progressing very well through the real economy, not disrupted by recent geopolitical shock. So on the left, we show that the US imports of AI-related products indexed to early 2023. And what stands out is the persistent divergence. What we can see here is the AI-related imports have rising sharply, while non-AI imports have remained relatively flat. So that tells us today's AI cycle is driving incremental demand rather than just simply riding a broader trade recovery. And on the right, we see the mirror image from Asia. Clearly, exports of AI-related products from Asia, including China, Japan, South Korea, and Taiwan, have accelerated heavily, again, far outpacing the non-AI related exports. Because Asia is increasingly acting as the manufacturing and supply backbone of the global AI build-out. In other words, the build-out is not just a market hype. It's showing up in measurable trade flows. And in February, we compared the AI investment cycle to other historical build-outs, such as the railroads, and concluded that the AI investment cycle was still in a very early stage. So to remind our audience, here, the dark red line in this chart is an average of the investment across these past build-outs. And we were expecting that the AI cycle will continue in a similar manner, represented by the dotted line in this chart. However, the most recent data point shows a quite significant acceleration. That means investment has increased at a faster rate compared to these past episodes. So the momentum has been even stronger than we initially expected.
Thanks a lot. Now, AI spending is not equal to benefiting from AI. We have, especially in our last webinar, talked a lot about AI spending. You just referred to it as well. But especially when we look at companies, single companies, AI spending may be quite different from benefiting from AI. How do you, do we distinguish between the two aspects, spending and benefiting?
Yeah, that's a very great point. Actually, since late last year, there has been a clear shift in how markets are thinking about AI. Now, the market focus has shifted from who is spending the most to who can actually turn that spending into stronger profits.
Profits, yeah.
Yeah, and we have already seen this very clearly during earnings seasons. Because now, simply announcing higher AI spending is no longer enough. Now, the investors want to understand how that spending is playing out and whether that spending will genuinely improve the earnings over time. So in this context, we start to see a rotation in market. The US value stocks and non-US market began to outperform. And this shift has started before the Middle East conflicts, which would suggest the move is structural rather than just event-driven. And that matters because this part of the market actually includes more of the AI adopters rather than just the AI investors. These are companies which are using AI to improve their efficiency, productivity, and profit margins across their businesses. And within the US growth stocks, and especially the mega caps, the picture has been more nuanced. We see some companies are still seen as well-positioned, but others, particularly part of the software sector, for example, have already struggled as investors would question whether higher spending will really translate into higher profits. So the broader takeaway is very simple, that as the AI story matures, returns are becoming more and more dispersed, and diversification away from the US megacaps matters more than it did at the very early stage of this AI cycle.
Great, thanks, Grant. So some movement here within the AI theme, but overall, it's still going to be a very dominant theme within the year. Now, before we conclude, let me share our updated end of March forecasts for both equities and fixed income. Let's start with equities. Now, on the left-hand side, we see our current valuations for a range of equity markets. At the top, we see Australia equities, then followed by US equities, US value stocks, developed markets, XUX, and at the very bottom, we have emerging markets. And compared to a little more than a year ago, the end of 2024, we see that Australian equities have become quite a bit cheaper relative to our fair value estimate, which puts them towards the lower end of the fair value category. By contrast, US equities, developed markets, ex-US and emerging markets all fall into the stretched categories, as we can see. Emerging markets have become noticeably more expensive when compared to the year-end 2024. But what I would like to point out here is the divergence between US value stocks and the wider US equity market as far as valuations are concerned. The reason for this discrepancy in one and the same underlying market is the expensiveness of some of the larger companies in the US equity market, which then renders the overall market, which is essentially a weighted average, a capitalization weighted average of its pieces, to be somewhat expensive. Now, on the right-hand side, we see our 10-year forward-looking returns. And in terms of median returns, which is represented by the horizontal bars in the middle of these box and whisker plots you see here, US value stocks are expected to have the highest forward-looking returns with as much as 8% per annum measured in Australian dollar. On the opposite end of the spectrum are emerging market equities with an expected return of 5.4%. Now these comparably higher and lower forward-looking returns are at least in part also driven by the valuations that we just saw here on the left-hand side. US value stocks being relatively cheap and emerging market stocks being relatively expensive has an impact on their forward-looking returns. Now moving on to fixed income, we again find our fair value estimates on the left-hand side of the chart. And as we see, changes relative to our December 2024 forecasts are relatively small. With the exception of global credit and US high yield, both of which are fairly expensive, all other categories, including Australian bonds, are fairly valued. Now, as far as forward-looking returns are concerned, we find that all fixed income categories are fairly close to one another. As we see on the right-hand side, median annualized returns all range within a spectrum of 5.3% and 5.8%, so quite attractive returns compared to the pre-COVID area. And that brings our update to its end. Now, to summarize, we discussed that renewed energy supply shocks have lifted inflation and are weighing on growth. However, we expect the impact on markets to be fairly limited as we see, or unless we see further escalation. Second, we believe that AI will remain to be the most influential driver for the economy in 2026, despite the geopolitical events that we discussed earlier. And third, our investment outlook remains largely unchanged. We continue to favor high-quality fixed income, US value stocks, and developed markets, ex-US equities. Now, before we say goodbye, I want to remind everyone that you can find our economic and market outlook information and commentary put together by Grant and his team by following the links that you see on your screen. And that leads me to say a big thank you to you, Grant, for joining us today. And of course to all of you, to our audience, for tuning in. We hope that you found this update useful and informative.